to a more than $12 billion market this year. Big enough to prove what I would call the product market fit. There's demand for decentralized finance services. There's no doubt about that yet, but not big enough yet to have, with the current Ethereum infrastructure, 400 GY gas price and incredibly expensive transaction fee, because there's too many users with a blockchain that is Ethereum layer 1 that cannot scale. So right now we are in a very sweet spot, big enough to prove there's a market, but not big enough to crash everything. And basically now it's the responsibility of the main actors and all the people that dedicate incredible resource to scale either the Ethereum network or other network, to be able to transform what is right now a very good proof of concept, tested in prod, as we say in DeFi, that is a $12 billion market with maybe 20 to 100K users, to something that will be used by and that is ready to be used by the mass adoption, which is millions of users and billions more, much more billions dollars of deposits. And that will happen either on Ethereum layer 2 or on other chains. And we already have like some diversification outside of Ethereum happening. Like, for example, the Binance Smart Chain is very big on yield farming these days, and so on and so forth. So it's a very interesting point of time to be in, because we prove that there's some demands, but there's still so many things to do. We are very early. You are still mute.
We can't hear you, Alex.
I was muted, sorry. I had a curiosity, and it's about from the moment when gas fees skyrocketed in Ethereum, what has been the effect that you have noted? Because it's clearly that the market and the operations are still growing up, but I guess probably the small operations that people were just trying out just didn't make sense. So I guess they drop, and now people that is using it is using DeFi protocols with amounts that make worth the gas fees. Because, for example, I tried some operations for very few quantity of it, and the gas fee was higher than, for example, the tokens I was like to claim, for example.
Yes, exactly. So basically, Ethereum right now is a DeFi chain. So
just to check, can you hear me?
Oh, yes, go on.
Oh, yes. Okay, I will not switch in the video. So, because last time when I switched in the video, then my voice disappeared. So, no, first time when I switched in the video, the server crashed. Second time when I switched in the video, my voice disappeared. So, I will stay just voice only. Okay, please continue. I will jump in by the next questions.
Okay, thank you. So go on, Mark, please. We were talking about the change in usage because of the gas fees.
Yeah, yes. So basically, Ethereum this year and since this summer is becoming more and more a DeFi chain, because only the financial aspect of the blockchain is mainly used and makes sense to pay the transaction fee. Because as we are talking right now, the gas price on Ethereum is 48 EY, which means that sending Ethereum will cost you maybe 10 to 15 cents, but sending tokens can very easily amount to $1 a transfer, and interacting with smart contract will go from 5 to 10 to $20 a transfer. And if you don't have big deposit amounts, it just doesn't make sense to use Ethereum. So basically everything we had on Ethereum that were not DeFi kinda have gone either directly working on development on layer 2. I'm talking about small NFT projects that are very cool, like Minbase, like that is currently developing on Near, even other applications that were not financial, all this kind of stuff. They are gone now because DeFi took all the block space. And that's a bit of a shame, because blockchain is public and is for a wide range of application. And I think the only solution to that is scalability, but it will not happen with Ethereum 2.0, because obviously Ethereum 2.0, the deposit contract will happen sometime in December, but the full activity on Ethereum 2.0 will happen maybe in 2021, probably not, maybe, but more 2022 and so on and so forth, and we never know. So all of that has to happen on scalability layers that we call layer 2. And we have like several technology allowing that, like Near, Matic, XDAI, if we talk about sidechain, or any other project like that.
Don't you think that maybe...
Can I
go ahead.
Martin, smart credit here. I will not switch in my video like said last time. It crashed the server. So, okay. I think what is the issue is like if you're looking on Ethereum now, very many assets are on the Ethereum. Actually, most of the assets are in Ethereum, like most of the tokens and so. People want to use them. Now, the issue is now the gas. Yes, the issue is the gas. But now let's ask a question. Why should we run then the smart contracts on Ethereum and use the assets on the Ethereum? Because from one side we have a contract like a program, and from other side we have the asset. What's about giving to the users in the future the possibility that we say that the users, they can choose on which chains they run the programs, and they do cross-chain collateral locking. So, for example, you use some chain which has much cheaper gas cost, which means massive utility to the user, massive benefits to the user, and you do cross-chain locking and be the assets where they are. Because at the moment we have both on one chain. We have assets and the program. Program has a high gas cost, but if you succeed to separate them. So, and just to say in smart credit, that's all long-term vision, just the separation to run the programs there makes the cheapest, and to take the assets from there where the most. Okay, just to answer your question about the usability.
Very interesting, but I'm afraid or wondering if that changes won't add some more friction to new users. What do you think?
Yeah, and how are you going to do the interoperability? Sorry, I'm Tito, sorry for the interruption.
No, go ahead, please. Let's keep it an open discussion.
Yeah, I think that one of the problems is if you have another chain that is for the usability and Ethereum is only for the assets, then how are you going to tokenize the assets on, let's say, Eternity in non-custodial manner? Because if you want to tokenize them, you should deposit these ETH assets in, let's say, some Ethereum smart contract or directly to your wallet. And you should make the interoperability with some oracles, or I don't know. In our case, we are using HTOC smart contracts, but it's just for swapping. It's not possible to do much more complicated logic. So yeah, we are always talking about moving assets from Ethereum to some other chain and then using them. The other chain a second layer solution. But the problem is who is going to be custodial for these assets on ETH chain? Where are they going to be stored? And yeah, that's one of the problems.
Yeah. Also, one comment here. We can think of course, as solutions like Polkadot is doing. Perhaps the multi-chain approach is the way to do it. You use the native asset, but you just create bridges between the chains, and this how maybe you will fix that custodial problem, if I'm not mistaken, Tito, of course.
Yeah, that's a good option, but if I have to be honest, I haven't really seen any real-time utility of Polkadot. I mean, it's a great idea, it's a great project, but maybe it will take a few more months or a year until we see such kind of bridges in practice. If someone has an example of bridge with Polkadot and some other chain that is in production and works, it would be great, but I'm not aware of such thing.
You can use XDAI, basically, the stake sidechain. So it's not a layer 2, it's a sidechain. So it's basically a copy-paste of Ethereum, but you remove the proof of work to dedicated proof of stake. And basically, it was like made famous in the ecosystem, like with the burner wallet that was allowing like a small payment in DAI in the community. And basically, they deployed more and more application there. Like they have their own own Uniswap, they have their own NFT markets, all this kind of stuff. But at the end of the day, in terms of user, it's very, very small. And in terms of volume, it's very, very small as well.
Yeah.
Also, one thing here to add, if we take back a bit the conversation about user experience, and if people want to really use native crypto assets to actually, let's say, pay bills, then it's still quite troublesome. I think many of those DeFi users still remain on the blockchain. They trade on the blockchain, but what happens afterwards with the asset is still not very clear. And what we're trying to do also with Piixpay is really to kind of connect these two worlds together and make that real usability, like really to make people use those assets and I think this is the way to do it, to go to that mass adoption that we need.
Yeah, completely agree. It's like the ramp, but I guess probably, and this is like a reflection that I'm doing in loud voice. This is probably for not getting attention of regulators, because this DeFi madness is like remembering me. And I know that we have heard a lot of this, not the ICO thing, because it's different. I mean, I don't want to go in the topic of comparing DeFi with ICOs, but there is one thing in common. And I remember those times in which ICOs were like made without any KYC, anything. And now it's something that we can't even think about. So maybe if we are starting to put ramp-offs for DeFi protocols to fiat, it will get more the attention to regulators, and they will start like asking for KYC and MLAT procedures and so on, which I find pretty difficult to implement right now in how the DeFi protocols are, because you just need an ETH account and it's completely permissionless.
Yeah, I mean, every time, you can always add some KYC or AML. It's not that hard, and you can put some permissions on the smart contract, for example, some whitelisting or whatever. But this will kill the idea a little bit. So we should, I think that the regulator should find something in between that suits the developers and DeFi protocols, and at the same time, it is some kind of KYC and AML, but which is not that restrictive. And regarding the off-ramps, I think that we have many of them. For example, Coinbase or Binance or some other.
Yeah, sure.
You can move your assets to these exchanges and withdraw them, I mean.
Sure, maybe I didn't explain myself correctly, but I'm not seeing like a tight integration. Of course, you can get your assets that they are coming from your DeFi operations and that made the ramp off. But up to the moment, and maybe I'm wrong, I'm not seeing in the native DeFi interface an integration to do directly the ramp off. Maybe it's not needed. I mean, you can always just get your assets and go to any exchange, to your favorite fiat exchange, to do the ramp off.
Yeah, of course. Yeah. It's also a question of KYC as well in your ramp. And
it's Martin here again. So, like I worked for 10 years in a Credit Suisse, and so now all this KYC and these AML policies, they will come anyhow. Now, let's be aware. Let's look on regulatory landscape. What is happening? There's now this AML Directive 6 coming. Now, AML Directive 5 has been implemented. There's Directive 6 coming. So it's getting more and more stricter. Now, why it's getting stricter? Okay, that's all kind of hypothesis from smart credit is by introducing these very strict regulations, actually the regulator is protecting the banks, and it makes it pretty tough then to enter the new entrants. So this is the regulatory landscape that we see, and this means as well there will be side effects on this on DeFi. There will be more side effects and so on. Now the good thing is, of course, because everything is transparent. Everything is on the chain, so everything can be traced down. And maybe by using this transparency of the chains and chain transactions, it's possible then to mitigate this, the aim of the over-regulation that we are seeing now. I think, okay, that's our speculation. It is coming, so it cannot be just avoided. DeFi has increased a certain size. It's quite big. And, well, we just don't know in which form it's coming.
Yeah, Mark raised
Yes.
his hand just before. Please go ahead. Yeah, I'm particularly interested.
So there's two aspects in this question. The first thing, do we need KYC for on-chain transactions, so directly interacting with a DeFi platform? The answer is that technically it's a possibility, as it was raised just before, not right now. So if you want to use Aave as it is today, and you want to add KYC, whitelist, all these kind of technicalities, you cannot. And even if the government asks us, the Aave Genesis team, to add that, we don't have admin key because we are a decentralized finance protocol. So it's actually technically impossible to add it. So the only way for the government to, or any jurisdiction to force that will be to deploy a new version of Aave and say the current version of Aave is forbidden, and deploy a completely new version of Aave with this kind of privacy killer features. That's the first topic. That doesn't mean it cannot happen, because obviously they are bigger guns than us, as we say, the regulators. And but the second thing is that I don't think there's a lot of need for that, because who can already today buy and sell crypto without KYC? It's impossible. If you want to buy like more than $100 with someone that you met on local Bitcoin, good luck, because Coinbase, you need to KYC, Transact, you need to KYC, whatever exchange, you need to KYC, and obviously for $10 you can find someone that are willing to take your cash to give you something, but it's not really important for anyone, aren't it? So they already control very well the get in and the get out, the on-ramp and the off-ramp part. That's the most important part anyway.
Yeah, but if Bitcoin is developing well, at some point you'll be able to buy everything with Bitcoin, to live with Bitcoin, to rent a hotel and whatever. And yeah, this will, I mean, if you want to launder some money, you can do it. You can keep only the Bitcoin and you can live with it. So if it becomes something like a world recognized currency, like the dollar or the euro, then they should regulate it as well. I mean, I don't want to be regulated. I'm a libertarian as well. But
I'm sorry to tell you this, but if Bitcoin is the...
they will try to do it.
I think you nailed it, Tito. There is this famous meme from Matrix that is saying, like, I think it was something like, so are you telling me that one day I will be able to change my Bitcoin for $1 million? And the guy is saying, no, I'm saying that when you are prepared, you won't even need to.
Yeah.
And that's the point. Yeah, I think it's a very good point, because we are like very focused on fiat, but it seems that it's not having his best days.
Okay, we have to face, but fiat will have a continuous monetary inflation. So, like there is a, let's be aware, there's a one inflation that we see that the statistic is publishing, but this is not the real inflation. So this inflation got changed by the family Clinton in 1990s so that they can pay less to the retired people. So there is a real inflation that we can see, and this is then money that is created, the new money. And let's think in US now in the next last 12 months, it's at 35% new money created. And the more people will understand it, the more there will be as well movement towards as well crypto. And I hope there will be as well movement more towards the DeFi, because it's not only just about the mean of payment and so, it's about the financial services. And we wanted to speak here about the financial services and DeFi, so I'm trying now to bring it discussion back to the DeFi.
Yeah, perfect. George wanted to talk. Please go ahead. George, I thought you were raising your hand. Otherwise, we have a question from the audience from Jivan Jot, pasted in here in Telegram. I'm seeing, Jivan Jot, you'd like to speak. So if you want to turn up your mic, you can make your question yourself if you want. If not, I will read the question from the chat. Okay, I will read the question then. So Jivanjot is saying the current problem, I can see why people don't want to leave Ethereum, because having huge investment at on earlier stages cause influencers to talk about it more than any other better chain. What are your suggestions on it? Will making more unique protocols to cover another aspect of the market can help to make other chains on the road? Maybe then influencers look to it more seriously.
I'm not sure if the problem is that much with the influencers, but most of the development, most of the applications, and basically the infrastructure is the most well developed on top of Ethereum. For example, we have Infura, we have MetaMask, which has 1 million users. We have a lot of smart contracts built on top of Solidity, as this is one of the most stable blockchain programmatic languages. We have a big user base of developers, like I said. We have support from Microsoft, Amazon, and other corporations. So it looks like the most solid choice. And if you are a newcomer and you want to build a project, most probably you choose Ethereum. So I think that this is the competitive advantage of ETH, the infrastructure and the development community. It's not that much about the influencers or about anything else. It's about the traction that they have and the developers.
Yeah, and also it's like if we talk about DeFi, about this money Legos and composability and so on, it's clear where the pieces of that Legos are now. But again, we are here to change, and also other chains are working on it. For me, DeFi, like a lot of other things into this new era, shouldn't be exclusive or right to only one chain. I think that would be another centralization point. That is not what we are looking for. But definitely now all the action is happening on Ethereum, and it's like some barriers to go on. But I have no doubt that we will, and other people will overcome these barriers.
Alex, was this a question?
Can you hear me now?
No, I was just
sure,
a comment, and I was checking if there were new questions. Also, there is like the typical. I know this might be a typical question, but it's very, very important, and I would like to raise it here about what have we learned about security in DeFi so far, because we have had like some incidents, like let's say like this. And of course, I'm aware that if you want to make a system stronger, you will have these issues. But I would like to have your opinion about what we have learned so far about security in DeFi until now.
Maybe we don't have to test in production.
Well, that's not a bad starting point.
Exactly, it's just to support Tito, what he said, like there's this verb called banana software from the Microsoft, this big company, Microsoft. So it said like software is getting ready when it's shipped to the end user now. So you start with a green banana and then it gets yellow when it arrives now. In the DeFi sector, it's really testing. So you can develop source code fast, but it's testing. And I think the events, what we all know, I will not quote them. So many of these events are rather this, what Tito quoted, testing in a production. So if your question was, what have we learned? So this is the answer. The testing is a separate discipline, more testing.
But in terms of, so can you hear me, guys?
Yes, go ahead, please.
Just in terms of users as well, if we talk about security, then people are really in a very unsecured space when we talk about DeFi. They go to Uniswap, they see a token with the same name, they buy it, and then they realize that somebody just created a fake pool. And this is, I think, a big problem that we need to fix as soon as possible. And because the more we have these stories, the longer will be the road to real like DeFi to mass.
Yeah, I think that one of the most important thing is the due diligence. everyone is responsible for his own actions, and people that are part of DeFi should understand this. With the big freedom comes the big responsibility. So if you want to be everything to be non-custodial and to have full control over our assets, we should take care of our public and private keys. We should take care of what transactions are we sending, what tokens are we buying, and all these small stuffs that they may look like something that is not that important, but this is pretty important thing. And yeah, I would say that the due diligence and research before you buy the next token and go after something is super important. And we have learned this during the ICO craze, but nowadays we see the same problem and pattern. We obviously see that there are some tokens that cost like $100 on day one, and after that the price is dropping significantly, and people are owing for that because they want to make some quick money. But yeah, we should make our research. We should check what is the project, what is the team behind it, and only after that we should decide if we want to be in or we should stay away from that project.
Yeah, agree. The regular cautions in any investment. Mark would like to speak. I think I see your raised hand.
Yeah.
Go ahead, please.
So if we have to sum up what happened this summer in terms of security and risk, well, first thing, decentralized finance means decentralized, and decentralized also means permissionless. That means the best and the worst can happen without any limitation to be published. That means the worst cannot be stopped to be published on the Ethereum blockchain, and they cannot be stopped to publish a front end and call themselves yield farming new stuff, and then rug pull you from all of your money, or basically doesn't rug pull you, but when you allow in the UI, basically you allow a contract that is allowed to take all your money. And that basically happened many times during this summer. And yeah, the worst can happen in DeFi as the best because it's permissionless. And for me, that's not a bug, that's a feature. It's us as a community to push the project that do the best audits, to do the best effort to inform the public, and maybe, as it was just said, not jump into a project because it written that you will make 5-digit returns, because obviously in real world you cannot make 5-digit returns in something that is not a scam. That's the first thing. But if we put that part and maybe consider it for what it is, very high risk and maybe very low rewards, and you focus on the main DeFi protocols, you realize that no, you have bug bounties superior to $1 billion, because at the end of the day, that's what it is. There's more than $1 billion in the Aave deposit contract. There's $2 billion in the Uniswap contract. There's $2 billion in MakerDAO, in Compound, all this kind of stuff. And those projects still survive to this day. Obviously, we all spent a lot of money in audits, and we always triple check code and all this kind of stuff. But at the end of the day, it's a good sign that we didn't have like a $300 million hack into DeFi yet. And the more DeFi is resilient to hackers, the best it is for the ecosystem as a whole. And even to the point or myself, I'm feel more safe in the DeFi protocol than in CeFi protocol, because what happened this summer as well in CeFi, you got the KuCoin hack where a lot of user funds got stolen. You have OKEx, for example, where you cannot withdraw, and I don't know where you will be able to withdraw. And you had like quite a lot of issue in CeFi this summer. So at some point, decentralized finance is kind of proving itself as being more and more secure by the day. Obviously, you will always have that project, but that's one of the features of decentralization. That's not an issue at all for me.
Yeah, we have always to find our need the balance between sovereignty and security. Not everyone is like wants to hold the responsibility to do that. But I'm glad, Mark, you raised this point about the returns, the high returns, because we are seeing like very high returns. And first, I would like to. This question is like two-sided. First, about the sustainability of these high rates, but also, and mostly important, is like, what do you think about DeFi protocols competing in yields with their own blockchain in which they are built? I mean, for example, now when proof of stake is implemented in Ethereum, I guess there will be some sort of competition to attract capital, either to be locked in a DeFi protocol or either to be staked in a validator contract. And I think that that's like a bit a two-sided sword too, because if DeFi yields are very attractive, more than the staking and the securement of the network, the native network, we can have like a lot of money locked in DeFi with a relatively less secure network, because the stakers or the staking capital is not being devoted to stake, but it's being devoted to be locked in DeFi protocols.
What you call competition, I call it synergies, because at the end of the day, a lot of it will, starting in December, be put in the deposit contract of Ethereum 2.0 phase 0. That means there's less supply available to offer available ETH, and basically it's a one-way ticket, the Ethereum 2.0 phase 0. So a lot of people will say, maybe I will take the risk to beat the returns on Ethereum 2.0 by borrowing in DeFi some ETH, depositing in ETH 2.0, pay the interest for 2 years, and the returns I will get on Ethereum 2.0 will be higher than the total of the interest I will pay on DeFi. It's a very risky bet, but it's maybe a good bet, because the expected return on ETH 2.0 will be 22% at the beginning, but we know that those returns will go down, and right now you can borrow it on DeFi for at a stable rate for 2 or 3%. So that arbitrage is very, very risky. I do not recommend to take it, but some people will take it. And as more and more people take it, the return on DeFi of their depositing and providing liquidity of ETH will increase, obviously, because the market ate the boat and ate arbitrage opportunity, because usually when there's money to be made, people making it. So that's quite a good synergistic approach between staking and depositing into DeFi, I think.
Yeah, good point, Mark. Martin, you wanted to speak?
Yes. Okay. What I want to say is like no. Okay, the one is what we have on there's some inflation on the underlying blockchain. That's okay. But now let's think, where is the real income coming? So if you're speaking of the yield protocols, on the end, there are not so many possibilities. The first possibility is, okay, money market funds, okay, Aave, or fixed income funds. That's the smart credit. That's the first possibility. The second possibility is then we have service fees. Let's say we create a Uniswap pool, we put the liquidity in, and we get some service fees. But now it's getting already a little bit interesting. So, because we have to look at the service fees, yes, we earn them, but what happens with my asset value that I put in a liquidity pool? Maybe I lose it. Oh, there is already a risk. So that means we have the ways to earn fixed income or money market funds. We have the ways to earn the service fees. And the third way is, of course, we can receive the tokens, the reward tokens. So these are actually the three possibilities. And now on the end of this, we have this multitude of combinations. Now, I'm a Swiss banker, spent 10 years in a Swiss banking. So I would say, down to earth, let's look what is real. Because in this, what we see now in the yield kind of thinking, so I think people are taking too high risks. They are like speculating. Okay, let's look on Uniswap pool, that the Uniswap pool gives a 20% return, but in the same time it loses the value, the underlying value of your asset. Or you speculate on the token prices and so on. I think it's maybe better in the DeFi if you start to think, what are these actual incomes? And these actual incomes that people get, these are the real use cases. Fixed income and service fees. These are the real use cases. So now, if you look on this yield mining as a way to do the arbitrage, I welcome this. Arbitrage is required, because to the arbitrage we'll get a fair price between the assets. That's very good. And at the same time, let's think, what is the real source of income? So, okay, my comments on the yield mining. So, not the mainstream, but let's say with my conservative viewpoint.
Thanks, Martin. Mark, go ahead, please.
Well, in terms of income, I have to defend for, of course, the lending platform. What we have to understand is that who are the people happy to pay 6 to 8% on stable coins to liquidity providers? Those people, most of the time, are and when we look at the on-chain data, obviously we are not here behind every user because it's decentralized, it's permissionless. For us, every user is just an Ethereum address. But when we look at the data and what they do with the stablecoin they borrow, because most of the time it's stablecoins, is that they buy more of their own collateral. It's leverage long. Like most of DeFi right now is leverage long on assets. And basically they borrow stablecoins in order to buy more assets. And when you look at the performance of usually it's not an investment advice and there's a lot of risk, but those guys are traders. It's their job to take risks. And when you look at the DeFi markets, well, at the end of the day, for many assets this year, you are very happy to have paid 6 to 8% a year because most of the assets have overperformed the interest rate paid. And at the end of the day, the interest paid are from actual economic activities. And when you compare DeFi to CeFi, how does it cost? What is the cost of doing a margin long on the CeFi platform? When you look at the actual APR interest rate of what you pay in DeFi platform, you will very easily find double-digit or triple-digit rates on the margin funding rates. And at the end of the day, if you are a trader, it's better to pay 6, 8, 12% than 70 or even more than 100% that what the CeFi platform will make you pay most of the time.
Good point. I think Martin.
Oh, okay. Let me add it as well. Like, if you look on a traditional finance, like we have something like these things like what's called this hedge fund servicing. That we service the hedge funds. So I don't remember the name now. And practically in this business, we are getting a very high return. So, okay, high, yes, we're getting maybe 8%, 9%, 10%, and so on. But there's always as well a risk behind. Because this risk means if you're serving the hedge fund, okay, it's called, sorry, prime brokerage. So the main clients are the hedge funds now. And if you serve the prime brokerage, there's always a risk behind now. And it's a risk because we don't know where it's going, what is happening with the assets. Now, let's look now at the DeFi. Now, Mark mentioned that a lot of this is going to collateralized lending and lending again. Indeed, what we see in DeFi or own analysis is like the monies which are borrowed in the DeFi. A lot of them, they are fed as well into the central exchanges. And the central exchanges then, the long positions are taken. So on the one asset or the other asset. So, practically, so if you're thinking now of the prime brokerage business model, like 8, 9, 10%, okay, for the very big players. So practically, DeFi is kind of democratized prime brokerage business model as well to the people like 99.9% who are not then the hedge fund clients. So, of course, the money is borrowed together and then feed it into the further trading activities. So, but it's important is this is let's get back again to the yield and the yield mining topics. There has to be a real economic activity behind. So some borrowing or trading. So there has to be service fees. So just if you're combining these different assets. And then if you're taking too high risks, I think this in yield mining, these risks are not always transparent. So, what I'm saying is, let's look always back. What is the real service behind it? What is the real benefit created? So, I mean, that's most important.
Nice reflection, Martin. Yeah.
Traditional finance. What we need is we have to just to transfer these assets from traditional finance, the activities into the DeFi. So one by one. Okay, back to you, Alex.
Thanks. I think George wanted to speak.
Yeah, just a comment here. It really depends, of course, also what kind of market states we are, and if we are really in a bull market, then really people will be more adventurous and taking more loans on DeFi. And if not, then I think this is a very big question as well in DeFi. What happens when the market crashes really hard and really fast? I think we need to really think about that as well, like in that scenario. Just a perspective here on the conversation.
A good one.
I think we had quite the event of volatility this year. I want to remind everyone what we called in DeFi the Black Thursday. So it was the 12th of March of this year, or the COVID crash in traditional finance. And most of the assets in crypto lost from 30 to more than 55% in around an hour, which is the worst volatility event of the Ethereum history, basically. And DeFi was already there in March 2020, and we had like millions of dollars of liquidation in Aave. The same thing in MakerDAO, and MakerDAO basically lost $4.5 million this day, and same thing with Compound, and it was a widely distributed event in the ecosystem. But DeFi didn't die that day. Like liquidation happened for everyone except Maker that day, as expected. And it was not even the only mass liquidation event, because liquidation works both ways. So if you borrow something and that thing value goes very high in value, you can get liquidated because basically you did a short and you get margin call on your short. And that basically happened with Chainlink, where a huge entity that shall not be named borrowed a lot of Chainlink, and the price of Link went from $6 to $20. And basically we had around $40 million of short liquidated on Aave, and the liquidation happened as expected. And $40 million liquidation is huge for DeFi back in the days. And so far, I think DeFi proved a lot of resilience around that.
Yeah, talking about risk, how do you see insurance service coming into the DeFi space? Because I guess it will be like the prices to assure this risk won't be very like if we look to the risk and premium relationship. I guess not a lot of, and I don't know. I'm just asking you guys because you have much more experience than me. If there are already companies that are willing to insure and to provide insurance to DeFi protocols and services. Yeah, Mark, go ahead, please. You have.
So there's several approaches happening right now. So you have the more traditional insurance with the mutual funds, and the leader on that is Nexus Mutual. They basically will provide you cover on the smart contract failure. It has to be a bug on the smart contract, and it has to be proven inside a claim. And basically, they can cover any kind of contract, and the premium on the cover range from 0.5 to 3% per year of the value of the deposit, depending on the contract. The bigger the contract is, the more audited the contract is, the lower you will pay. The second way to cover is by derivative and financial projects, and that basically in traditional finance the biggest markets. And the leader on that are options. So you have Opin, that was one of the first to market, but you also have Edgic, which is kind of growing these days. And it's the biggest one in traditional finance, but right now I think the DeFi ecosystem is not mature enough to understand those a bit more complex derivatives, so you don't have that much volume, but that's definitely something that's going to grow as the maturity of the whole ecosystem will grow as well. The third way, and I will finish on that, is the Ave approach. So we basically have the safety module with Aave, which is a smart contract fund where you can stake some Aave asset, which is our native asset. And basically for the responsibility of the possibility of being maybe slashed of 30% up to 30% of your deposit if there's a critical failure of the protocol. You basically earn the wide majority of the protocol fees plus the inflation of the Aave assets. And right now, we are the DeFi protocol with the biggest fund dedicated to that purpose, because last time I checked, we had $140 million in that smart contract.
That's quite a bit. Any other view about insurance?
Let me have this. Multiple topics to mention. Okay, the one is about the derivatives. Now, if you're speaking of derivatives, of course, if you look in our traditional finance, the ratio of equity to credit to derivatives is 1 to 10 to 100. Clear. So derivatives is very, very strong in a traditional finance. But let's be clear, if you are going on derivatives, this means as well that we have a counterparty risk. Now let's think of the famous Deutsche Bank, the most biggest derivative book in all the world. And let's think on the regulator, the German regulator, who is always scary to look on this thing on the balance sheet of the Deutsche Bank. So that means derivatives, it means there is a risk, but this risk is somewhere, and there will be a counterparty. Now, how liquid, how good will be your counterparty? How good is the Deutsche Bank? So that's this question. Now, instead of this, what to mention is, what we need as well is to understand that this insurance, when we are speaking of the insurance, it means actually that there has to be some risk-free rate. Now, and this risk-free rate already includes insurance. So this is these things. So because if you look in traditional finance, there is risk-free rate, and many elements are already included there. Now, and on top of this, we'll have additional insurances. So okay, like in a smart credit, we are doing them the credit risk specific. So like the loss provision fund concept. So and this means like because if you're going on derivatives, then we have counterparties, and counterparties will have the risk, which can be then quite intransparent. But if you're building, like if every protocol is building his own kind of loss provision mechanism and analyzing as well the risk-free rates, I think that's one way to deal with the situation. So I think it's quite similar what Mark said from Aave. So to build something inside of the system. Okay, back to you.
Hello, chaps. If I may, can you hear me? My name's Paddy.
Yeah. Thank you.
Hi there. Thank you. Yes, I'm just on this particular point what the last gentleman mentioned. I think it's a very, very important point. It's something that I'm familiar with. I am a derivatives trader, just for background, specifying in options, used to trade in traditional markets in London. So and across different markets, commodities, stocks, fixed income, etc. So, and now I trade almost exclusively BTC options. And I'm currently looking at alternatives to have this counterparty risk problem, which we have even with some, potentially with some of the big exchanges. That we saw a liquidity crunch in March when I was there. So on this point, I've been observing some interesting developments which third-party companies in the crypto space have been developing. In particular, one called X Margin, which seeks to solve this counterparty risk problem. And I would appreciate your views on this and how it could be applied to the DeFi. It is effectively, so it appears to me, I'm not a DeFi specialist myself, but I'm obviously interested in the space. And it appears to me that what these guys are trying to do is taking a DeFi approach, where effectively you hold the private keys to your collateral, right? You're not delivering it to an exchange. And then this service, X Margin, I think there's another one, if I remember, possibly Copper, it's called. So anyway, but these then have links to the exchanges and promise settlement based on your position at the end of the day, which is something that's kind of appropriates the clearing houses in the traditional markets. It's a similar sort of system. It's one that we haven't had in the crypto space yet, and it's desperately needed. But it could be a way to effectively settle precisely what you're talking about with regards to what I agree are the wild risks in DeFi derivatives, which are still being managed a lot by companies which perhaps, or development teams, which still could do with a little bit of additional experience of the type that we've seen in traditional markets. Not that I'm saying, not that I'm advocating, that we do everything by their book. Obviously, we're a new sector, and that's the whole point of us. But some of the methodologies there are possibly things that we could still learn from. And the clearinghouses, so that in a traditional market, like say one that works with the CME, Chicago Mercantile Exchange, or the London futures and options markets, as they were before they were taken over, they are sort of the exchanges are sort of owned by all of the participating members. So it's actually quite a democratic sort of way of organizing things in those ways. Not monolithic, and now it's changed a little bit. But the original ways in which the exchanges were set up was actually quite not egalitarian, but reasonable, right? And so maybe something like this, where all the participants, perhaps all the protocols, like Aave and the ones that we're talking about, could perhaps form, maybe even through like a joint association, a type of structure, a bit like what these guys at X Margin are doing. Funnily enough, actually, the founder and CEO used to work at my old company in London, so I know them. He's a good guy. He's and I really like what he's doing. But we could replicate that type of thing, or even perhaps gain some inspiration from that structure, so that we then have like a system where each participant, each trader and investor, doesn't give up their personal wallets and their keys, but does agree to create a settlement structure through this network with each of the protocols and exchanges that they're working on. Don't know if that makes sense, but I'll shut up. I'll shut up now. Yeah.
I think Mark has some ideas popping in his mind, so please go ahead, Mark.
Okay, great. Yeah.
I have a very good news for you, Patty. Bali. The settlement layer is called Ethereum. So basically, every DeFi protocol have their own application layers, and we all set up inside the same layer that is called Ethereum. That's why you can have that much money Legos and interoperability between protocols. Basically, at the end of the day, to illustrate that, most of the Aave users don't use actually Aave. And basically, a lot of our TVL, so value locked in the Aave protocol and depositing it to the protocol, doesn't come from Aave user directly. They are from Harvest Finance protocol, they are from YEarn protocol, they are from Curve, they are from Mstable, and basically all these protocols, in order to provide a better yield to their own users, they do their own jobs and they can focus on their core features. And on top of that, they will deposit their liquidity into Aave in order to get on top of their own yield, the Aave yields. And that's how they provide double-digit yields most of the time, because they stack on top of each other 2, 3, 4 protocols revenue on top of each other. And it's allowed because we all use the same neutral, decentralized, and permissionless layer that is called Ethereum. And that's why Ethereum is so strong today.
Okay, that's fantastic to hear. Thank you very much, Mark. I obviously have a lot to learn and look forward to learning more with you guys. And, out of interest, will there be a summary or some resources that are then provisioned following this talk conversation? Because there are quite a few points and that are interesting, and people that I'd be interested in connecting with in due course as well. So perhaps if there's a note about that, we can just highlight it towards the end. Thank you. Thank you to the hosts.
Cool. Thanks, buddy. Thanks to you. I guess Jivanjot wanted to speak. I don't know if he's joining in audio or video or. Oh, you can. Okay, Jivanjot. So maybe put your question on the chat. And in the meantime, I would like, because we have been talking a while about DeFi topics, but most probably some of you don't know what our guests are doing. So I would like you, Tito, Mark, George, and Martin to give a little brief about what you're doing in your projects for people to know them and to check what's going on the space. Maybe, I don't know, Tito, if you want to start, or George, I don't care the order, but please give some insights about what you are doing, please.
Yeah, I can start.
Thanks.
So we are building a cross-chain atomic swap protocol. So the main idea is to connect the different blockchains, because as we speak today, most of the things are built on top of Ethereum, but we have another chains like Eternity or Bitcoin, Litecoin, and many others. And it should be some way to connect all of them. At the moment, we have these centralized exchanges like Binance or Coinbase, but they are acting like a middleman. They have created bridges, but these bridges are based on HTTP protocol, and basically they are acting as custodial. For example, if you want to exchange, let's say, ETH for Bitcoin, you have to deposit your ETH in Coinbase. The counterparty should deposit his Bitcoin in Coinbase, and after that, Coinbase is going to send you the Bitcoin, and the other party is going to receive the ETH. But what is the problem here? The problem is that we need to have trust in Coinbase in this case. They are adding some extra taxes because of this custodial service that they are providing. And we are not sure what is happening with our assets. I mean, we are depositing them inside the platform, but maybe they are using them for something. For example, once Binance have used the deposited Stellar tokens to vote for something regarding Stellar network, and they made a big mess. So yeah, as much as the staking is coming, they can use your tokens that are inside the platform to vote instead of you. So this is a real problem. But yeah, my main idea is that we should have let's say, a bridge that is completely trustless, decentralized, and transparent, that allow us to exchange one token for another in different blockchains. And this is what we are trying to do with JellySwap. We are building many separate smart contracts, let's say, on the different networks. For example, in Bitcoin, we don't have smart contracts, but we have Bitcoin scripts, which are pretty simple form of smart contracts that are not Turing complete, but still are complicated enough to support some programming logic. So we have created this kind of smart contracts on every chain that we are supporting. At the moment, we are supporting Ethereum, Eternity, Bitcoin, One, Harmony. We are integrating Algorand as well. And we also support some other ERC20 tokens. Basically, we can support any ERC20 token that we want to. And with our platform, you can, in completely decentralized way, without any risks, counterparty risks, you can exchange, for example, Bitcoin for ETH. This is the most used case, because as we know, these are the two most famous coins. And yeah, because of these smart contracts that we have created something like a protocol that have some common interface. We have SDKs, and basically everyone can be a liquidity provider in our network, can put his own rate, and if someone else matches with him, they can do the swap. And we went one step further because we automated all of this. So if you want to be a liquidity provider, you just have to download our software called Butler, and you have to run it on your computer. As long as the software is running, you're participating in the network. At the moment, we have almost 200K liquidity in Bitcoin, ETH, Eternity, and the other tokens that I mentioned. By the way, we also have the Binance Smart Chain, because it is a Ethereum-like network and it was pretty easy to be integrated. So yeah, we are finding a lot of interest from people for such kind of product because it is kind of unique, and there are only a few more projects that are doing similar thing like Liquidity that is backed by consensus, and yeah, the other one are not that famous.
Wow, that's awesome, Tito. I must confess, or I'm myself a JellySwap user, and I'm delighted. It works like a charm. So, and I guess it's not very easy to do this kind of cross-chain swaps. I don't think it has been a matter of a couple of evenings to code some contracts. So really, congratulations, really. It's
basically it took
some
us
magic.
more than a year, and the thing is that you have to understand basically from blockchain, and you should do smart contracts in many different languages and many different chains, and there are some small differences, and that is kind of hard. It's not that easy. You should really know what
challenging.
you're doing. Yeah, you should
Seems
really know
quite
what
challenging.
you're doing. It's not just copy paste or move this here and there. You should be aware of.
Not testing production?
We are trying not to, but I mean, I was kidding of this testing production, but we all know that everything is in early stages. It could be hacked to basically anything. And we should be aware of that. DeFi, blockchain, and cryptocurrencies are very, very risky. No matter if the platform is live for 1 year or 2 years. It could happen some bug, or it could be some fork, or everything could happen. So we should be aware of that.
There is always a first time.
Yeah, we are basically in permanent testing production. But it is like this with any cutting edge technology. So
cool. Thanks a lot, Tito. Who wants to go next? George, please go ahead. George, I saw you raised your hand. Otherwise, maybe Martin or Mark.
How about now?
Oh, yes, I can hear.
Sorry about this. Wanted to crash again the server, right? So
no.
So a bit about Piixpay. We done the test in production. I guess we are the only one who here are not that much. Let's say having a protocol on its own, but we're very interested in the DeFi space. Basically, we are essentially a payment gateway between cryptocurrencies and fiat currencies. So we're specialized in the so-called off-ramping space, where we handle all remittance that happen from crypto to fiat. We help basically companies, that individuals, to pay bills, loans, services using their crypto, while the recipients, on the other hand, gets always euro fiat. We also help merchants to accept crypto payments, and this is very important for those merchants because they have a new payment channel as crypto, but in the same time they can store always fiat. And essentially, why we are so much interested in DeFi is also that we want to help basically DeFi users to, when they have some kind of profit, either in stablecoin or Ethereum or whatever, then they should have some kind of a convenient way to use that in the real economy. I'm not saying that crypto is not a real economy, but just to pay actually somebody, a service provider, or make a third-party payment to your telephone company seems to be also like a use case that needs to be somehow tackled more effectively in the crypto space. We also have a dedicated API as well for that. Can be used as well to both on-ramping and off-ramping. We will also have soon ability to also buy Bitcoin on Piixpay, and also further on we will offer additional loans on that. So really looking forward to in the space, and I'm happy that I joined with so much smart and professionals who really understand the DeFi well, and happy to be here. Thank you.
Thanks to you, George, and also thanks for the help coordinating this.
Oh, my pleasure. Yeah, it was really, really enjoyable actually to get people excited to this, and I'm happy that everybody joined. And Alex, great work for you guys as well from Eternity, and well done for gathering us up there today.
Thanks a lot. Mark or Martin?
Okay, I can start. So, what we are doing, we are then Ethereum based. We are doing borrowing and lending. But we are doing a little bit things differently than Aave or Compound is doing. We are doing fixed term and we are doing fixed interest now. And this has some very, very positive side effects. One of the side effects is that on the borrowers, kind of a less collateral ratio than on the money market funds. This is a very nice. And then on the lender, on the other side, we can give us stability. Then we have as well widgets. So our idea is to integrate ourselves in pretty many other platforms. So to get more users. And the very important thing is our focus is on fixed income funds. Now let's think in a traditional finance. We have money market funds like Aave and Compound, and we have fixed income funds. And this fixed income funds is a little bit underserved in the DeFi, or it's rather like rather missing. It's not there. And what we are saying, these elements, these components that we have in a traditional finance, one by one, they will get copied as well into the DeFi sector. Now we have payments, we have exchanges, okay, we have money market funds, perfect, and we think now the fixed income funds. So these are the next thing, and we focus on the fixed income funds. So okay, that's smart credit what we are doing. So okay, back to you.
Great, thanks a lot, Martin.
And
Mark,
on our side, we
probably
are,
everyone knows Aave, but maybe someone not, so please.
If you don't know Aave, you are more than welcome to try it. And we are a DeFi money market on Ethereum. So basically, we are a financial middleware that is specialized in providing liquidity to the decentralized finance markets. So if you provide liquidity into Aave, your liquidity will be used by a wide range of actors in the ecosystem, and those actors will pay you interest. That's basically the main point. You deposit some assets into Aave and you collect a passive income. That passive income fluctuates up and down given to the supply and demand, and very seamlessly, your interest are paid directly into your wallet by the accrual of your deposit tokens every second. Basically, so it's an actual compounding passive income. And if you are a borrower, you have the option to pay variable interest rates, so that will go up and down depending on the market conditions, supply and demand, but also at the stable rate. So you can choose to pay a small premium and make sure that you have a complete vision and predictability on the cost of your loan. And we also created cool features such as the flash loans that made a lot of noise this year, because you can take up to currently $1 billion in loan without any collateral, but in the context of a single transaction. So if you do that to do arbitrage, liquidation, all this kind of stuff, you can make money without requiring any capital. And obviously, if you do that in order to hack protocols, well, it can be profitable, but at the expense of other actors of the ecosystem. And
well, you can only lose gas, right?
You can, and that's a great thing about flash loans, that a flash loan only exists when they succeed. Because if for any reason you don't bring back the money at the end of your flash loan, well, the transaction is reverted and you only pay the transaction fee. So all the flash loan you can see on the Ethereum blockchain are flash loans that have succeeded. So that's it. And we're gonna release in the next few days a version 2 of our protocol with a bunch of new features like collateral swaps and many other things that will be too long to explain right now. So feel free to join the Aave family.
Cool. Thanks a lot. It's awesome to see all what is happening in our small and beloved crypto world. I don't know if anyone wants to jump in and make any question or comment. Please, is the moment. Otherwise, I think we're going to start to wrap up this starting session. Don't be shy. Just at this point, you can just turn your mic or camera or write in the chat, and I will make the question. Okay, there is a question here for Tito. I have a question for Tito. For AA projects wanting to do public launch, can Jelly Swap be used? For example, Uni on Ethereum kind of experience for traders wanting to buy AX9 coins?
Maybe it could be, but we should make our due diligence and to check if it's a security token, because at the end of the day, we don't want to give some legal consequences and
some letters of love.
Yeah,
love letters from regulators.
Well said. So yeah, we are trying to stay away from such kind of tokens. The other thing is that if we are listing some assets, basically we are requiring the protocol to assure us that it will be some liquidity, or if the token is like ETH or Bitcoin, that's not a problem because this is the most used protocol. But we just we make our due diligence and we decide if the token is worth to be listed, and basically we have to spend some development time. If it was like Uniswap where you can list any token automatically, that's fine. But at this moment, every time when we want to list some new token, especially if it's not on ERC20, because with the ERC20s it could be pretty fast, but if it's not on ERC20, basically it takes some time. So we have to decide if we have the development power at the moment to do it, and we should decide which projects are with higher priority.
Cool. Thanks. So there is a question for you, Martin. That is, if you are considering using Chainlink oracles, I guess it will be more the alternate side, but I don't know. That's a question.
Okay, at the moment we are not using Chainlink oracles, but of course we can discuss about this. So I will discuss with my CTO, with our CTO, my brother, this topic. So.
On this topic, okay. I have to share that Chainlink oracles probably sell millions of dollars to Aave lending provider during the Black Thursday crash of March. Like basically, almost every oracle system during that night crashed, and Chainlink were one of the very few ones that remained completely efficient and operational, and that's a very good thing, and that's why we are very attached to working with Chainlink so far.
Great. Any other question? Otherwise, I would ask our awesome guests if they want to do any final remark or conclusion to wrap up.
Okay, I can start. So we're speaking of DeFi now. Let's look big picture. So we have traditional finance and DeFi. We have to think that it's about that we take traditional finance and we take components of traditional finance and we move them one to one by the DeFi. Now we get sidetracked by some small topics here and there, but let's keep this big picture in mind. So parts of traditional finance have now been converted to the DeFi, but there are bigger parts of traditional finance which still have yet to be copied into the DeFi. So that's my final remark.
Thanks a lot, Martin. George, Tito, Mark, feel free also to just not make any final remark.
I would say that DeFi is a great use case, and basically it is the first sphere that proved that Ethereum and other public blockchains could be used for something more than ICOs and games, and it is something which scaled a lot. But I want one more time to set a reminder that everyone should be careful, and we all should keep in mind that DeFi is one big test ground. Everything is risky, and make no mistake that some protocol is completely bulletproof and your funds are completely fine. Your funds are not completely secure, and that's why you're receiving higher interest. Maybe with the time, the interest will be lower and the risk will be lower. So this is important thing to keep in mind.
Yeah, I think maybe the question is not if a protocol or a platform will get hacked by when, but when.
True that.
That's a real question.
I
George,
completely
please.
agree with go for it, George. Sorry.
Oh, please.
I completely agree with the risk part, and I would highly recommend everyone to have a hardware wallet. So basically, I had to help, but at the end of the day, I was not able to help a user this morning, not directly of Aave, but of the community that got his private key compromised, and basically there were nothing to do, and he watched all his assets being taken from his wallet to the hacker wallet, and basically there were nothing to be done about that, and that's a very dire situation to be in. So please, if you have more than, let's say, $1,000 worth of crypto, please spend $50 or $70 into a hardware wallet. You will thank me later when you don't lose everything. And that's the first thing. The second thing is that yes, risk is high and protocol can go down, but most of the major protocol right now are spending a lot of time, effort, and money to make sure they are more and more secure. And won't you agree that DeFi is more secure right now than it was 1 year ago with the major protocol? I think it is, and in 1 year, maybe, as you say, the interest rate will be lower because obviously more liquidity and bigger competition between the platforms, and more accessible liquidity mean less interest rate because there's maybe more demand but more offer as well. But also the risk will be even lower in 1 year. And I think we're getting there slowly, step by step. But we are doing our best as protocol to make sure that your funds are safe.
Yeah. Also, one point.
Right.
Do you hear me, guys?
Yes.
Yep.
Maybe to finalize here is really I agree with all the points mentioned in the guest by the speakers, and it's really about education. Really trying to, we as the leaders, to trying to communicate the right ideas, the right practices to novice users. And at the same time, I'm quite happy that despite that we are entering some kind of a wild political volatility, actually crypto is quite becoming more stable. And it's becoming this kind of island which unbanked users can use it and can benefit from DeFi. And that's quite powerful. So I think in the future, people will actually have that security and have that maybe wallet that is either fiat to crypto, or they will not recognize it, but still they will be enough serviced, and they will have access to that real decentralized finance as we want it. So that's like my final kind of word.
Cool. Okay, so thanks so much. Really, it has been a big pleasure to share this evening, even with the incident. So sorry again for that. It has been amazing to share this space with you and share the knowledge you have with the audience. And tomorrow, a little reminder, we are starting with the kickoff of the Human DeFi Hack. Today we had the warm-up session, and tomorrow we will be having the kickoff with the people mingling, the welcome, solving of dApps, explanations, and so on. So tomorrow at 4, same hour, and we hope without any incident. I hope to see you all here. And Mark, Martin, George, Tito, really, thanks a lot for this time. I know you are very busy, and it has been a real pleasure to have you here.
Thank you all.
Thank you. Thank you, everyone.
Thank you all.
Thanks a lot.
Thanks a lot, and let's be in touch. I have seen some synergies popping around, so let's follow up on them.
Bye-bye, guys.
Bye.
Thanks a lot. Bye-bye. See you tomorrow.
Bye.